Okay. Hello. This is KCLau from KCLau.com, and I also have Ian here. We are doing this YouTube live to talk about this topic, the 5 principles we learn from the 100 beggars. So let's just start right from the bat. What is considered 100 beggars? Ian.
Oh, yes. Hello, everybody. My name is Ian, content producer at KCLau.com. So with that, let me just share with you my slides. So the thing is that we can see here on the screen that The Hundred Beggars is actually a book. It's actually the title of a book by Christopher Meyer, whereby he did actually a study on stocks which has actually returned 100 times from the investor's original investment. So which means to say that for example, if you actually invest $1 into a stock, then the stock actually grew in value and it actually returned its investors $100. So it's actually so that kind of stock is actually known as 100 beggars lah.
100 beggars.
So
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 it can be
what yeah
multi-beggars, right? Maybe 10, maybe 5, whatever it is. But 100 beggars, it just sounds like, wow, great, right? Put in one
yeah
dollar and get $100 back, right?
mhm,
So yeah, but I also read this book and we
mhm.
we like it very much. But let's go through the disclaimer first. We are not recommending any stocks today. And in the book, right? Basically, Chris Mayer, he also studied. He said he's not the first one who wrote the book, so there's someone
Mhm.
else who wrote the book. But it's a very good book, and he redo the version, which I like it very much, and we actually very highly recommend people to read about this. And we have gone through the disclaimer. You can pause the video and look at it. Let's start with a few principles that we learned. Like the first one, what is it about?
Oh, so the first principle that I believe it is actually very important that I find it starstruck lah, all right, is actually this principle called the twin engine. Okay. So just now we talked about the 100 bagger, whereby every single dollar that you invest in the stock, it returns $100. So which means to say from $1 it becomes $100. So that is actually called the 100 bagger. So from Chris Mayer's research, what happened is that there's this principle called the twin engine, whereby the twin engines are actually these two, earnings growth and PE ratio growth. So as long as investors actually focus on the growth of a company, so the 100 beggars doesn't actually happen in like 1 or 2 years' time. It actually happens in a prolonged period, like for example, maybe 10, maybe 20 years down the road. Okay, because you need time to actually make this happen, which will actually lead to another principle that we'll be sharing later. But then over the time period, the company that you actually invest in should actually deliver consistent growth, all right, in terms of its earnings. So that is actually the first engine of growth. So earnings must grow. That's the first one. Then the second one will be its PE ratio. Okay, PE ratio is actually a valuation ratio. So in certain instances, you can actually use that as a metrics to actually gauge whether or not investors are interested to actually buy into that stock. So PE ratio growth, if there is a stock whereby it's experiencing PE ratio growth, right, which means to say that investors are interested into um investing into the stock, so therefore the price actually goes up. So if let's say PE ratio grow, it means that the demand for the stock has increased.
They
So
just prefer they say okay to pay more for the stocks now, right? Maybe compared to
yes.
maybe when initially. So the twin engine is saying that you grow from these two things. So the first one,
Mm,
the let's say it become 100 beggars, it doesn't necessary that the earnings become 100 times. Let's say he earn
mhm,
the stock is like earning $1 now a year per share. But 20 years later, it earns $100. Of course, you become 100 beggars, right? It follows the earning.
mhm,
But this could be just one part of it. Maybe he earns just 50 times more.
mhm,
But the other 50 actually come from the PE. Maybe the PE multiple. When you pay, it's like PE 10. But then it become PE 20
mm.
after it grows like 50 times of the earnings. So you get the both added together still 100 beggars, right? 50 times
Correct,
2.
correct.
Yeah. Nice. So how
So
about principle number two? That what kind of actually business can have this kind of like growth, and then people are very interested and pay more for it.
okay, so principle number two, right? So the thing is that not every businesses will actually eventually become the hundred bagger, because during this period of time where the earnings keep on growing and people are actually more and more interested into getting into the stock. So the key driver for this is actually known as the key drivers lah that contribute to this earnings growth and all this kind of stuff is actually called economic modes. So economic modes, they come in different forms. Okay. So I believe that most companies, right, who are actually in the 10, 20, 30, even 100 baggers, right, they will actually consist of one of the following modes. So from Chris Mayer, I kind of like listed down five, okay, five characteristics, or you can say five criterias lah, that you can actually consider as economic modes. So the first one is like strong brands. So strong brands is like, okay, like for example, Nike, right? So it's an apparel company, sports apparel company. So today, let's say KCLau and I, we decided to come in as an apparel manufacturer, and then we come up with a brand called Nika or Nico. It's not going to affect Nike in any single way. So that is actually called strong brands.
Yeah.
Then the second one is actually switching costs. Switching costs is like, okay, so like me and me and Casey, right? Both of us like our MacBooks, all right? So now I'm using MacBook Air, and maybe Casey is using MacBook Pro or just a Mac.
Yeah.
The thing is that we share this to other people, and who are actually still using Microsoft to actually switch over. But then the thing is that it's very hard if, let's say, uh you actually propose this idea to a boss and say, hey, why don't you just switch your entire staff's computing system, right, from Microsoft into Apple?
Yeah.
It won't work
Yeah.
for most of the time, because why? There's a cost to switching it from to convert them from a Microsoft user to become an Apple user. So it's very hard for them to actually convert, you know. So that is actually called switching cost lah.
Switching
Okay.
costs. Yeah.
Yeah. So it's, you can also say the stickiness effect. Means to say a lot of people, they tend to stick to
Mm.
Microsoft and not switch to Apple. But of course, for us right now, if you ask us to, from Apple user, switch back into Microsoft, will we do it? Usually we are very reluctant
Reluctant
also lah.
also. We're also reluctant. Okay. Yeah, same, right? Switching costs. So how about the network effects? What's that about?
Network effect is actually like the scale, the size and the scale. All right. So this one is actually quite simple. So it's like how I say leh? Network effect is a bit like
Maybe
okay,
like
let's
Facebook? Maybe it's like Facebook?
Facebook can be one.
Yeah. Mm.
Okay. But of course, this one, I'm not too sure about social media. Facebook used to have that kind of network effect, right?
Yeah. Mm.
But these days, with a lot more social media platforms which can rake in so much users at so many times, right?
Mm.
Then I guess there's lesser to that extent of network effect.
Okay.
But if you say Visa and MasterCard, whereby
Mm.
that
Very good
one will be a
example.
different story, which
Yeah.
simply because I'm still using Visa and MasterCard,
Yeah.
or even Amex. I mean, Casey uses Amex, so
Yeah.
that's actually network effect.
So even
It's
like
not,
Apple come up with Apple Card, Apple Pay, they still go through Visa and Mastercard, right? Same. American Express, same.
it's still it's still the same thing.
Yeah.
Doesn't matter what pay, whether you
Yeah.
have Alipay, Apple Pay, Google Pay,
Yeah.
Touch and Go Pay, whatever. Doesn't matter.
It's,
Visa and
it
Master
still go through them.
is
Yep.
still there. So that's the
Very good
network effect
example. How about cheapest
Then
provider?
cheapest provider, this one is like let me think. Maybe okay. I do not know whether is it cheapest, because but I guess Casey can verify to this lah.
Yeah.
So let's say like Costco,
Mm.
right? I'm not too sure whether it's considered as cheapest, but then the thing is that they kind of like promise their
Yes, yes.
customers, right, the best deal. If
Yes,
not,
yes.
I'll pay you. I pay you the difference.
Yeah, I would agree Costco is the cheapest provider. It's not like cheapest in terms of the absolute price you pay for their stuff. It's more like you get the good stuff at the cheapest price. It's like well-known brand. you can buy at a cheaper price. Let's say you want to buy Apple products, you can go to Costco and get a discount actually. You cannot get discount anywhere, even from Apple, but you can get a discount from Costco. So
Mm,
that's how they become the cheapest provider, in fact. So how about the
mm.
biggest insights? Like any example on this?
Biggest insights, there are a lot of examples of this. However, the thing is that among the five, right, maybe this
Mm,
biggest thing, right,
mm,
because whoever is biggest today, right, may not be biggest tomorrow. So by having biggest, it's also not exactly
mm,
the, I mean, it's not my favorite, my most favorite kind of
mm,
economic mode lah. So it's like biggest is like, okay, today, in terms of I do not know lah. I mean, why is it not my favorite? Like, let's say for example, car manufacturing, right?
mm,
You don't need to be the biggest. Even Elon Musk with Tesla, it's not even the biggest.
mm,
But it's not even the biggest. It doesn't sell the most amount of vehicles, but then in terms of market cap, it is the biggest.
Some I don't know. Maybe Google can be categorized in this like biggest search engine because they have the most information. They index the most in the world, so they can
Yeah.
give you the best search result. I guess maybe Google can be in that. What else? And maybe like user generated content like YouTube or still Google, right?
Mm.
It's like okay, if you want to find video, you have to go to YouTube, isn't it? So I think there's some sense to it, maybe, but might not be the uh is one of the economic modes, and some actually some brands some company they have a few of these, right? They have a few of these together.
Yeah, like Google, like just now you mentioned about Google, right? So
Yeah.
the thing is that it's the biggest search engine, right? But you don't want it to be the sole economic modes that the company has, right? So being the biggest search engine
Mm,
network in the world, so you need to also have network. So you need to also have, let's say, it kind of like overlap
yeah.
in terms
Mm,
of the number of economic modes it has. Like does it have a strong brand? Of course,
mm,
Google has a
yes.
strong brand.
Yeah.
Will you switch to Yahoo anytime soon? Of
No.
course, the
We
answer
switch
is
from Yahoo, right?
we
Okay.
switch from Yahoo, but we don't
Okay.
switch to Yahoo, right?
Uh,
So that's another one, lor. Then in terms of network effect,
yep.
the thing is that um because YouTube is not just about users, it's also about advertisers. So like Casey, you are also an advertiser on
Yeah.
Google and YouTube. Will you actually switch your advertising budget to Yahoo anytime soon?
Mm,
S-
mm,
So you can't, so that's all. So that is actually um switching costs.
yep.
You won't because you know that your advertising campaign will not be that effective. And if you have a lot of KCLaus who are thinking like that, then that's network effect lah.
Yep. Sounds
Mm.
good. And then how about the third principle? So the third principle, I think, kind of interesting. A lot of stock investors actually don't look at this. Owner operators preferred. Oh,
Yeah.
what is seen in the game?
Yeah. So basically the thing is that there are stocks that are, you know, the entrepreneur who actually founded the company and then he actually kind of like grew the company to a certain stage and he decided to list his company on the stock exchange. So that is actually the so that is actually what we call owner operators, right? So the business people who actually spend their lifetime, could be their lifetime,
Yeah.
investing their money, plowing in his time, his effort and energy, his soul and heart lah,
Yep.
into his business, and then he lists it. Okay. Why these companies are actually preferred? Simply because these operators, these entrepreneurs, they have a skin in the game, whereby their personal wealth largely is actually quite tied up to their own company, especially their company shareholdings. So we believe that for this kind of company, right, they will act in the best interest of shareholders because the operators themselves are
Yep.
the major shareholder. So
Yep.
they will actually act in the best interest of themselves as a shareholder. So likewise, they will act in the best interest with the rest of the shareholders, which are the minority shareholders lah. So in terms of shareholders' interests, they are more or less aligned. That's why they are preferred lah.
Yeah,
So that is actually principle number three.
you can name most of the billionaires. They most of them have skin in the game, right? They own their own companies, a lot of it, right? Major shareholders
Mm-hmm.
like Warren Buffett, Jeff Bezos, even Elon
Mm-hmm.
Musk, like Bernard Arnault, right? LVMH.
Mm-hmm.
So let's get to the fourth one.
All right, sure. So the fourth one is actually about the role of a CEO. So this is
Mm,
actually quite interesting, I find, simply because I didn't see it that way, whereby he actually put it so simply, right? Where the role of a CEO is capital allocation, which means to say his role, his job is to allocate capital. Okay, so how do you actually allocate capital? Well, first you need to raise capital. Okay, so there are two aspects to being a good CEO. Number one, you need to have capital. You need to raise capital. So
mm,
where do you raise it from? So there are many forms of capital, but in terms of finances, there are basically three ways you can actually raise capital. Number one, from your customers through business operation. Number two, you borrow money from the bank. So
mm,
that's debt. Or you can issue out bonds,
mm,
okay, to actually get bond investors to actually buy your bonds. So that's actually a form of debt. And last but not least, you kind of like raise money from investors through equity. So these are the three main ways that a company can actually do to raise funds. So now we have the capital in. The question is where the company should actually allocate this capital raise. So there are many choices, and typically the choices are as followed. So number one, the CEO or the board can actually choose to reinvest this capital back into the business to grow its business so that, remember principle number one, where the twin engine, right, is one of the twin engines is actually earnings growth. So when you reinvest your capital back into the business, it actually enhances the chances of these companies, right, to grow its earnings. So this will actually enhance the chances of success for this stock to become a bagger. All right.
yeah,
It may not be 100 bagger, but at least it could be a 50 bagger, 30, 20, or maybe even a 10 bagger also. I
yeah.
believe investors will be more than
Maybe we're
happy.
super happy, right? Okay. Then acquisition.
Mm. So the next one is acquisition. Of course, with the amount of capital, they can actually choose to acquire a relevant competitor. They can buy their competitor out, or they can buy their supplier, their distributor, they can buy their retailer, all right, and make it into a much more integrated empire, okay, so that they will be much more efficient. So that's one way to look at it. Or they will just, or alternatively, they can actually choose to acquire other businesses which are not so relevant now.
Yeah.
Okay.
Like some
Mm.
example of they call this serial acquirer. They put in a name for that. So there are some
Mhm.
company that do this like constellation software, and
Mhm.
also like one in Sweden called Technion. I think Chris Mayer also very interested in that company. And one example, very big one, Berkshire Hathaway, right? They have been doing acquisition for so long, right? Every year they will do some, and then now they have to do like big size acquisition just to move the needle, right?
Mhm.
So that is one kind of it. And what else can they do? Like the CEO
Of
when they have
course,
that capital.
of course, the CEO can choose to pay dividends to reward its shareholders. But of course, for Chris Meyer, because I think he's operating from the US, and in the US, right, dividends payout from a company are subjected to 30% withholding tax, so which is actually very high. So in that sense, from a US tax resident perspective, right, or anyone who wants to invest, or any individual lah, including myself lah, if I want to actually invest in the US, then then the dividends paid out will be subjected to a 30% withholding tax. So that is actually something which is not preferable if we are actually looking into the US market. Of course, the fourth one will be paying down debt. So this is actually another example of how CEO can actually choose uh, to use the capital allocated, pay down debt. So of course, the immediate benefit will be your balance sheet will look very nice. And of course, you will save on interest costs. Okay. So that is actually the fourth one. And last but not least, this is actually quite typical for US stocks, whereby they kind of like choose to buy back their own shares, which means I'm a McDonald, and then I'm already a very profitable company. I just choose to go back into the market and buy back my own share. So
Okay.
so that is actually the fifth one.
So in terms of the principle four is basically looking at the CEO and how he actually do manage the capital allocation, right? Where he get the
Mm,
money and where he put the money. So why CEO, they will do it strategically to grow
mhm,
shareholders value, right? Mm.
mhm.
So that's what we want to
Correct.
look at. Okay, how about the final principle that you learned from the book?
The final principle is actually known as the coffee can portfolio. So the thing is that in order for your 1, 2, 10, 20, 50, 100 baggers to work, right? It's not so much about speculating your way to that kind of bagger or trade your way. It doesn't work that way. Coffee can simply means that it actually encourages long-term holdings whereby in Chris Mayer's book, there is a story whereby there's this husband and wife. Okay. So the thing is that the husband is managing the wife's account. And then the interesting thing about this husband is that whenever let's say there's a investment advisor who actually or investment advisor or broker, they come up with a buy recommendation, right? So this guy will actually go and buy the stock. And then whenever the investment advisor actually recommend a sell recommendation on certain stocks, he don't sell. So
Oh,
he only take in the buy recommendation and
so
he don't actually sell. All right.
okay.
So it's not like so it's quite typical for investment house or investment firm or even a stock brokerage firm to actually have buy sell recommendations. Actually, by the way, for KCLau.com, right, we don't even give a damn about all these buy sell recommendation lah. Okay. But anyway, the story for Chris Mayer is this. This guy actually took in the buy, but then he never really sell the stock. He buy and just
Mm.
forget it. So that's why it's called the coffee can. He buy the stock, he put the certificate, because in olden days, right, you receive the paper certificate. So
Oh
you take
yeah.
the certificate and just put it in the
Coffee
coffee
can.
can lah.
We can call it
So that's
Milo
why
tin lah. In Malaysia, you can call Milo tin lah.
hello
Okay.
tin.
Okay.
Then
Okay,
the
so just
astound
buy and never sell, right? As time goes by, and then
as
it
time
gives
goes
the
by,
time for the stocks to actually grow into multi-baggers because it needs time.
yeah. So the thing is that there's a part to the story whereby this husband died.
Mm. Oh, okay, okay.
He died. So
Okay.
so the wife actually like, okay, these are the stocks lah that they own. So what surprises the investment advisor is that, oh, this guy actually took in all the buy advice and he never sell. So some of the stocks that he buy, let's say, because for most of the stock he just allocate, let's say $5,000 lah, US. Some of the stocks they go from 5,000 down to 2,000.
Mm.
Okay, that's very normal. All right, but there are certain stocks whereby he buy 5,000, eventually it goes a lot higher than 5,000. Like it goes into 5 or 6 figures worth
Mm.
of investment value. And that 5 or 6 figures in investment value, right, can offset
Or the
all the
loser.
all the loser. And
Let's
then
say
if
you have hundreds, you have 10 stocks in your portfolio, and
mhm,
nine of the 10 stocks all goes down. Doesn't make you
mhm,
any money. But only one become 100 baggers. So it,
mhm.
it overcome all the losses that you incur for the nine stocks, isn't it? So that's the principle of it,
Yes.
is it? Okay.
So yeah, that is actually that's a very extreme example, because if you happen to follow the five principles, very rarely you become nine. Take 10 stocks, nine are losers one lah. Okay.
Yeah.
No way, no way it can happen lah, unless you decipher or you
Yeah.
understand the whole principle wrongly lah. But typically in a more rational case, right, in a more practical case, usually maybe one or two is a loser, but then you have one or two which is a wild winner lah. So that is actually the coffee can portfolio lah. Anyhow, the story here is that there's no market timing involved, no trading involved, and don't be a seller. Be a reluctant
Okay.
seller.
Okay, awesome. Let's recap the five principle in the next slide, and then almost it. All right. So let me recap it. So the
Yep.
five principles we learned from actually 100 baggers is the twin engine of growth, right? Earnings and PE growth. It can contribute to your baggers, and then economic modes, business with very good business environment that they built a moats for themselves, a defensive mode. So we are also interested in the business that are still operated by the founder, right? Owner operators. They have skin in the game. They have a lot of shareholdings actually tied to the equity of their stocks. And then the role of the CEO, who are very good capital allocators, and also the coffee can portfolio, which you buy and then never sell. Let it have time to actually grow, right? Okay, awesome. So that's it for this video. And if you guys are interested in learning more from us, we operate the website called KCLau.com. So I'm the founder, and now I have Ian to help me on that. We have the Money Tips ebook series, which is free for download, and then we have weekly webinars where you can actually interact with us with live Q&A. We bring in many experts to talk about various topics about personal finance, and also we have articles. We have online personal finance courses, and we even have the Chinese version of the website as well, zh.kclau.com. You can check it out. So this is my latest book called Money Smart. The link is where you can buy it from Shopee from my publisher directly. And there's a Chinese version of this book as well, translated from the English one. 理你才乖. You can check that out as well. And then that's all. Make sure you're in my email list. We actually have this free ebook for you, which you can read, and I give you a guarantee if you read for 15 minutes. And if you feel that you don't learn anything from that 15 minutes, you can ask for a 10 ringgit compensation. So you are either wasting your time 15 minutes, and you will not waste your time, like at least I pay you if you think you are wasting your time. But usually people who spend 15 minutes, they will learn something and they will never ask this money from me. So take up this challenge, go to kclau.com/LP or the Chinese version at zh.kclau.com. Thanks, Ian, for the elaboration about 100 Baggers. I also highly recommend that book. Go buy it. It's actually in Malaysia. It's published by my publisher as well. We have the same publisher. Okay. So thank you so much. And we'll see
Yep.
you in the next YouTube video.
Bye bye.
Subscribe to our channel too. Bye-bye.